The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin Jeong. In today's complex and rapidly shifting global market, investors face an unprecedented challenge. Central banks are moving in different directions, inflation remains uneven across regions, and geopolitical tensions add layers of uncertainty. Against this backdrop, traditional safe havens like cash or ultra short-term instruments may no longer deliver the returns investors need, while longer duration assets carry heightened risks. This makes short-term interest rate strategies more relevant than ever. Offering a unique blend of stability, yield, and liquidity, these strategies provide a flexible and resilient way for investors to stay productive without taking on excessive risk. So to find out more, joining me now is Angus Hui, who's Deputy CIO and Head of Fixed Income at Fullerton Fund Management. Angus, welcome to the show.
Great to be here. Thank you.
Thank you so much for joining us. Well, Angus, how do you interpret the current divergence in global central bank policies like rate cuts from the ECB and RBI versus the Fed holding steady? And what does this mean for fixed income investors?
Yeah, overall, interest rates are high in most countries right now, and interest rates, in our view, are likely to drop in many places. This overall would offer some opportunities in bond market for both capital gains and some higher earning yield. When you think about it, right, after COVID, every country's situations are very different. For example, what we see in Europe, the ECB, the European Central Bank, may have one or more rate cuts, and then we might actually need to consider interest rate hike next year, as now we see defense spending going higher, and that may impact growth and inflation. However, for example, looking at the US, we see economic conditions remain resilient. Inflation likely to start picking up soon. The latest number on inflation of 2.7% was broadly in line with expectation. The interest rate will only drop, at the time when the waiting for until the inflation number seeing signs of coming lower. But in other cases, for example, in Japan, we're likely to see a wait-and-see approach, despite the rising inflation pressures. So we got upper house election coming this weekend, but and also together with tariffs that affect growth in inflation. Going back a bit closer to home, we have Asia, that we expect some interest rate cut in Thailand, Korea. But however, some other countries that are higher yield, like Indonesia, India, they offer pretty good yield. Really going home in Singapore, liquidity is ample, so it does actually support rates at a rather stable level for here. So overall, there are a lot of opportunities from either picking the right places for capital gain, but also overall higher yields are helping investors to get some coupon income in the meanwhile.
So what do today's market dynamics mean for conservative and growth-focused investors alike?
Yeah, in our view, fixed income, should be a core position for both type of investor. Let's start with the conservative one. So a lot of our investor has been putting money into, for example, MAS bills or also fixed deposits. As MAS bill yield has been falling now, and fixed deposit, some of the rates are actually very low now. So they should take this opportunity just by tidy step up the curve, looking at some of the shorter maturity, duration bond that can pick up some additional yield. And by doing some of the shorter dated investment grade credit, overall investment grade credit in this environment, credit quality is pretty stable. So for that, it will help to improve return, but not necessarily, introduce too much additional risk into their portfolio. But for those that focus on growth-focused investor, well, I imagine, I will be interpreting those that been actually investing more into, for example, equity market or high-yield bond. So this is also a good opportunity to just diversify into shorter dated credit, investment grade. Overall, that should help stabilizing return, but also reducing the overall risk of the portfolio. I think one thing, we really always want to urge investor is we also a lot of investors tend to overlook and forget there's a currency and FX effect. So a lot of the investor, for example, look at equity, might have invested in US equity for past few years. Return has been great. But now, if they consider some of the Singapore dollar, credit strategies, for example, this help to manage some of the currency risk, as a lot of the equity market, are also using dollar in the US markets as well. So it diversify the portfolio. In other cases, looking at local currency market may also make sense in the environment when dollar, have been weakened.
So with inflation remaining sticky in some regions and softening in others, how should investors adjust their fixed income allocations accordingly?
Yeah, I mean, a lot of the inflation, is going to be partly at least driven by the tariff. So as we sort of shared before, we expect, the inflation number to start picking up sometime in July. So basically, the number that were coming out this month and next month. So the Federal Reserve in the U.S. now have a mixed view on whether, U.S. inflation is sticky. So i.e. they are staying longer for a longer time, or the impact is likely to be temporary. In our view, we actually think, the inflation issue would be a temporary one. It's a transition one. It's unlikely to be a major concern from the market, performance point of view. We do believe, we are in an environment of Goldilocks, so it's quite constructive for credit. So, stable growth, inflation under control, and financial market tend to do, reasonably well. In Asia, versus, for example, US and some other part of the world, just overall, inflation hasn't been a big problem recently, and mostly are within most of the central bank target. So with a weaker US dollar, there are some room for Asian central bank to ease further, and this also will help some of the Asian bonds as well. So overall, this is a pretty good environment for credit, as well as, for investors who want to invest in some local currency credit that benefits from the weakening dollar trend as well.
Okay, so why are short duration fixed income strategies especially critical in today's environment of, uncertain and divergent interest rate paths?
Yeah, I mean, as you point out, we are in an environment when, there's quite a lot of uncertainty from a geopolitical side, from economics, from policy, from tariff. And when we think about it from our return, right, for investor, as a result of that, there's been very good liquidity in Singapore. So MAS bill rates are also falling. So from a short duration bond fund point of view and bond strategies, it can benefit from firstly, capital gain as the Fed, start cutting rate later part of the year. So the impact of the One Big Beautiful Bill can also, help to support growth in the U.S. But in our view, it's still too early and a bit unclear about the long-term implications to the government public finance profile. So, and this is, by the way, not only the issue in the U.S., but it's also we see similar concern in other countries, including, for example, Japan and part of Europe. So as interest burden, right, from the government increase, we do expect, some of the longer dated maturity bond, they tend to underperform in those environments. And hence, by holding short duration bond is quite critical in this environment, to have more stable return and getting some coupon income in the meanwhile.
Okay. So can you explain how short-term interest rate strategies help reduce duration risk and why this matters to both conservative and growth-focused investors?
Yeah. I mean, typically a short duration strategy tend to focus on bond with a diversified portfolio, and they're all quite short dated. So the portfolio hold a bond, the strategy hold a bond, and then waiting for mature, and then reinvest in some other short dated bond. So the volatility, of the strategies, right, of those bonds tend to be less volatile. Now, they're also less sensitive if interest rates go higher relative to the longer duration strategies. So, for example, in a 10-year bond and the 30-year bond, the capital losses can actually be quite significant, if interest rates go higher. For the shorter dated strategies, the capital losses tend to be much less, from an interest rate point of view because of the duration. So in this environment, we do expect short-term interest rate to drop somewhat. But also at the same time, we can also, carry and enjoy some of the high interest rate than what we have seen in the past 2 decades.
So how do these strategies compare to, ultra-defensive options like T-bills or holding cash in terms of yield and risk?
Yeah. In our view, the short duration investment grade credit strategies, particularly for those that has a Singapore dollar component, is a good alternative to T-bills. And but also cash, because of the ample of liquidity in the banking system, fixed deposit rate is now fairly low, and also investors need to lock in for a certain time, right? For example, it's a 3 months, fixed deposit is 6 months. Sometimes it could be going, even beyond that. So moving into either money market or shorter dated strategies, you are able to, broadly speaking, preserve capital, but also deliver a higher return than, for example, lock in the cash into, let's say, T-bill, and then without much liquidity, and while the interest rate from T-bills and the cash is actually much lower now than used to be.
So then what factors should investors consider when selecting a short-term fixed income approach or fund today?
Yeah, it's a very good question. This is something we have been doing for every day over the past 20 years. Unlike equity, you think about bond. The capital outlay for bond is actually quite high. So the minimum lot, for example, in Sing dollar bond is typically about $250,000, and in the US dollar bond is $200,000. So from constructing a portfolio, diversification is crucial. It's very important. That reduce overall risk, but manage to maintain a similar level of yield and return expectations. So from investor point of view, fixed income strategies that can expose to a large number of bonds, for example, 100 and even more, for a very much smaller lump sum to start, this actually helps to produce a lot of the stable income. When we think about, investing, into fixed income, security selection is also important, and credit rating can only serve as a guide. So in the case of some of the market, for example, like the Sing dollar market, some of the bonds are also unrated. So how do we know, right? Those bonds are properly compensated for the risk we are taking. So at Fullerton, we have a team of sector specialists. So we are doing, research on those bonds and make sure what the investment on those, when we look at the credit fundamental, it's important to pick those that are actually stable, but also, with a reasonable use as well. I mean, another consideration really for a lot of investors would be the liquidity. It's always good to have liquidity. That means for investors, they can use the cash somewhere if they want to. There could be sometimes just a change of investment opportunities. Investor may want to, sometimes wait and try to get into, let's say, a opportunity in equity. But in the meanwhile, why lose all the income and carry, right? So in the meanwhile, can also invest into some of the fixed income strategies. Again, I think we have to urge investor, don't overlook currency effects. For example, for Sing dollar based investor here, the Sing dollar based strategies would help as the dollar has been weakened over the past 6 months or so. And yield is also another consideration. Sometimes retail investors tend to focus on, the yield means return, and the higher yield means better return. And that's not necessarily the case. So yield doesn't, sometimes there could be capital gain and losses. So just by chasing yield, without really knowing the credit, it actually can be quite dangerous. So knowing the performance of a strategies also on the market is important. So sometimes people ask the question, okay, do we or shall we be trading in and out of a bond? Then I think my answer is usually don't. But and sometimes we may not even want to look at the performance of a bond, right, on a day-to-day basis. But it's important to keep an eye on it. I mean, if you think of an example, it's a bit like you're doing a health check. If you are healthy, you don't need to check your blood pressure every single hour. But from time to time, you still want to keep an eye on it, and then you know whether the overall condition is. So getting to know the mark-to-market is actually important for investor.
Well, on that note then, could you help us walk through how Fullerton's short-term interest rate strategy delivers a combination of stability, yield, and flexibility?
Yeah, I mean, when we invest in the short-term interest rate from a strategy point of view, those who focus on investment grade, high yield is a different proposition. It fit a different, some of the investor with a different return expectation that take more, certainly more risk. So the short-term interest rate strategies focus 100% into, investment grade quality, credit. And but not only in Sing dollar, however, you also include the US dollar market. So that I think is important for investor that can have a more broad, market access. And again, as I sort of talked about a little bit earlier, manage the currency stability. So it's important that, for investors who invest in the US dollar credit, then unless there's a particular views on the market, it's good to have the hedging and back to Sing dollar. And also, I think it's important that, for investing in any strategies, you're looking at the overall long-term track record and your experience to pay out well at the time when there are different cycles.
Right. And before we let you go here, how does consistent reinvestment and compounding of modest yields in short-term instruments create a powerful tailwind for portfolio growth?
Yeah, I mean, as one of the famous quote, right, from Albert Einstein, compound interest is the eighth wonder of the world. So my take on this is certainly my advice is try to avoid large drawdown, and having a incremental positive yield pickup over time. It does matter after, years and beyond. This also helps to buffer for the volatility when investors invest in, other instruments. And at the same time, it's important that this powerful tailwind, right, from yield is also a key consideration when we need to protect our purchasing power against inflation.
Some great insights from you there. Thank you so much, Angus, for joining me today.
Thank you. I appreciate it.
Thank you. That was Angus Hui, who is the Deputy CIO and Head of Fixed Income at Fullerton Fund Management. This has been the Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.